Hi, welcome to Standard Chartered TV. I'm Stephen Green and I'm the head of China research here in Shanghai. I'd like to spend a couple of seconds talking about global imbalances and China's role in them and how the world at the moment is adjusting. Over the past 5 years, we've seen China running huge trade surpluses. China's exports have really gone everywhere and grown very, very fast. Same thing in the Middle East. Middle East was obviously a strong exporter over the past few years as oil prices went up and energy demand also grew very, very fast. Over on the other side of the world, you had the United States, and the United States was running huge trade deficits. People were consuming more than they were producing, so they had to import a ton of stuff. That was an imbalanced world, and one of the things we're seeing in the last few months is some parts of the world are beginning to rebalance. The US, the trade deficit has improved. Over in the Middle East, the trade surplus, again, has improved. No one is buying oil, less people are buying oil, and oil is much cheaper these days than it was a year ago. So parts of the world have rebalanced, or at least beginning to rebalance. Some parts of the world, particularly China, however, are not yet rebalancing. In the first 4 months of this year, China's trade surplus was 30% bigger than the trade surplus in the same period of time last year. China seems to be getting more imbalanced while the rest of the world is gradually getting back to balance. What does that mean? Well, it means that a ton of liquidity now is entering China. Every month we're now seeing $15, $20 billion trade surpluses. That money is still coming into China. What does that mean? Well, it means two things. One is that the currency, which is still more or less pegged to the dollar, will probably have to begin to appreciate again quite soon. For the moment, at least, this year, we think that renminbi will remain pegged to the dollar. But that pressure, that trade surplus is signalling a fundamental appreciation pressure on the currency. And so over the long term, or at least over the medium term, we expect the renminbi to break its peg with the dollar and begin to appreciate again, probably next year when exports start to revive. The second thing it means, though, that because that liquidity is coming into China and because growth seems to be coming back as well, we are looking for more inflation in China at the end of this year and the beginning of next year. And that creates a big challenge for the authorities because, like any other central bank or economic team of economic managers, they want growth, but they don't want inflation. And so sometime over the next 6 months, we're going to see Beijing, if we see this economy continue to recover, we're going to see Beijing beginning to tightening through appreciating the exchange rate, but also probably having to raise interest rates and do other things to control inflation in China. That is how China will have to adjust. It's just that adjustment is going to take place in 6 months' time. It's not happening today, but it does mean it's going to have to happen one day very soon.